Hi, my name is Dan Packard. I'm a CPA located in Idaho Falls, Idaho with Cooper Norman. Given that many of you have questions about recent tax reform, I wanted to take a brief moment to discuss some of the basic provisions of the Tax Cuts and Jobs Act. I am going to focus on provisions that have more sweeping applicability for individuals and for businesses. If you have questions, feel free to reach out to us at Cooper Norman for further explanation and guidance regarding this tax bill. The tax bill is formally known as the Tax Cuts and Jobs Act. The bill has been approved by Congress and has made its way to the White House for final approval and signature. The tax bill impacts virtually every individual and business on a level not seen in the last 30 years. In general, the tax bill calls for lowering the individual and corporate tax rates, repealing many credits and deductions, enhancing the child tax credit, modifying business tax deductions, and much more. The bill also impacts the Affordable Care Act. Please note that virtually every element of this tax reform has an effective date starting in 2018 and beyond. To begin, I'd like to discuss tax reform as it relates to individuals. First, there have been modifications made to the individual income tax brackets. Under prior law, individual income tax brackets spanned from 10% all the way up to 39.6%, with major leaps in marginal tax rates for married taxpayers with taxable income greater than $77,000. For example, a taxpayer in the top tax bracket in 2017 would pay 39.6% marginal tax starting at a taxable income of $480,000. The new bill carries with it tax rates spanning from 10% to 37%. The largest leap in marginal tax rate remains at $77,000 for married taxpayers. However, you will note that the taxable income over which each rate applies has been widened. For example, a taxpayer in the top tax bracket in 2017 would pay 39.6% in marginal taxes starting at a taxable income of $480,000. Under the newly enacted bill, a taxpayer enters the top tax bracket of 37% with a taxable income of $600,000. These rate changes in the bill expire after 2025. While ordinary income tax brackets have changed, the tax treatment for qualified dividends and for capital gains have remained unchanged from 2017. Also, please note that the bill does not repeal the net investment tax or the additional Medicare surtax, which has historically impacted taxpayers with large amounts of passive income or very large wages. While the net investment tax has remained intact, the penalty under the individual mandate to have health insurance has been removed. While taxpayers can expect a lower effective tax rate, please be mindful of the substantial modifications that have been made to the standard deduction and to the personal exemptions. The new tax bill calls for a near doubling of the standard deduction. Previously, married filing joint individuals had a standard deduction of $13,000 and single individuals had a standard deduction of $6,500. Under the new bill, married filing joint individuals have a standard deduction of $24,000 and single individuals have a standard deduction of $12,000. One goal of a higher standard deduction is to simplify the tax filing through cutting those taxpayers who would otherwise do better by itemizing their deductions. However, for a vast majority of married filing joint taxpayers, those with allowable mortgage interest, state income taxes, local income taxes, real estate taxes, and sizable charitable contributions will find it more difficult feeling the benefit from having made those payments. With fewer individuals claiming those deductions, this could have a broad impact on real estate prices, and it can also impact charitable organizations. This presents a need for taxpayers to evaluate the amount and timing of certain charitable contributions that they make every single year to maximize their use of the standard deduction as well as the charitable contributions that they are making. The bill eliminates the deduction for personal exemptions through 2025. However, an enhanced child tax credit is positioned to make up for some of the difference for certain families. I will discuss this enhanced child tax credit in just a moment. So we've discussed the modifications made to the standard deduction. The tax bill further makes substantial modifications to individual itemized deductions as well. First, the phase-out for itemized deductions for high-income taxpayers, this has historically been known as the PEAS limitation, has been entirely repealed. Consequently, high-income taxpayers can expect to receive more of a direct benefit for itemized deductions in future years. However, while the repeal of the phase-out is beneficial, the bill simultaneously eliminates many of the itemized deductions that taxpayers have historically enjoyed. First, mortgage interest deductions are now being limited to interest on mortgages of $750,000. Historically, that limit has been $1 million of acquisition debt. Second, the tax benefit of paying state and local income taxes has been substantially limited to now being deductible only to the extent of $10,000. This $10,000 cap is inclusive of real estate taxes paid as well. The bill enhances the medical expenses deduction as well. The bill lowers the threshold for the deduction to 7.5% of AGI for the tax years 2017 and 2018. There has also been a repeal of other miscellaneous itemized deductions such as unreimbursed employee expenses. While this was discussed heavily, the alternative minimum tax does remain for individuals with some modifications. Now, as a reminder, the AMT is a parallel tax system designed to maximize the amount of tax that an individual has to pay. The AMT is imposed at a nearly flat rate on an adjusted amount of taxable income above a certain threshold. This threshold is known as an exemption. Historically, the exemption has been at about $84,000 for married filing joint taxpayers. The bill increases this exemption for married filing joint taxpayers to about $110,000. It also raises the exemption phase-out level so that the AMT exemption would apply to an income level of $1 million for joint filers. The bill increases the current child tax credit from $1,000 to $2,000 per qualifying child. Additionally, up to $1,400 per qualifying child would be refundable. The bill also raises the adjusted gross income phase-out thresholds. Historically, that phase-out threshold has been at $110,000. The bill raises that threshold to $400,000, making the credit available to more taxpayers. This enhancement to the child tax credit has been highlighted as one of the provisions that will lower the overall tax liability of middle-class America and will serve as a remedy to the elimination of the personal exemption previously discussed. The bill retains the student loan interest deduction and keeps most of the education-related credits, such as the American Opportunity Tax Credit, intact for future benefit. However, the bill does not renew the above-the-line deduction for educator expenses that expired at the end of 2016. For taxpayers who pay and receive alimony, the taxable impact of such payments has been repealed. Previously, the maximum federal estate tax rate was 40% with a $5.5 million individual exclusion, which married couples were capable of combining for a total of $11 million. While the maximum federal estate tax rate remains at 40%, the bill does introduce new exclusion amounts that will allow a married couple to exempt up to $22 million for 2018 from any estate or gift tax. Heirs will continue to receive a stepped-up basis for inherited property for purposes of subsequent sale. The bill is set to sunset after December 31, 2025, and revert back to a $5 million exclusion, absent some additional congressional intervention. This recent change has many taxpayers considering the usefulness of large gifts from their estate. Taxpayers with marital estates in excess of the old $11 million exclusion would likely benefit from exploring gifting options within the next few years. I'd now like to briefly cover some of the impactive business tax laws. Currently, the top corporate tax rate is 35%. The bill revises this top corporate tax rate to 21% beginning in 2018 and makes permanent this revision. Taxpayers considering which entity type is best for them should look beyond just the tax rates. Each entity structure, whether it be a sole proprietorship, an LLC, an S Corp, or a C Corp, presents different opportunities and barriers. Furthermore, deciding which entity type you'd like to employ based on tax reform can be problematic, as laws are subject to change with political climates. I recommend that all decisions surrounding entity type should involve your CPA, as well as an in-depth discussion about past, present, and possible taxation structures that may impact you. An exciting change to the bill was the revisions to the bonus depreciation and Section 179 depreciation. The bill increases the prior 50% bonus depreciation allowance on new equipment to a 100% depreciation deduction for property placed in service after September 27, 2017. Furthermore, it expands bonus depreciation's applicability to used property as well. The bonus depreciation rate has fluctuated radically over the last 15 years. It has been seen as a means to incentivize business growth and job expansion. The 100% bonus depreciation is set to be in effect till December 31, 2022, after which it is scheduled to undergo some form of phase-out. Section 179 has historically allowed business owners to expense up to $500,000 of qualifying property in the year of acquisition without regard to whether the property was new or used. The bill enhances this expensing limit to $1 million, subject to some limitations. Now, the differences between bonus depreciation and Section 179 narrowed substantially with this new bill. However, there still does exist some small differences between the two. The IRS categorizes assets into classes, namely 5-year assets, 7-year assets, 10-year assets, etc. Section 179 expensing can be applied to a single asset acquired in the year without impacting other assets acquired in that same year of the same class life. Bonus depreciation is known as a class election, meaning that if you elect to bonus depreciate one asset of a specific class life, it is required that you expense all qualifying assets within that same class. A combination of both bonus depreciation and Section 179 will likely be a part of most business owners' ongoing tax strategy. Previously, most business use vehicles were subject to depreciation limitations. Most business use vehicles were limited to a $3,160 first-year depreciation limitation. The bill raises this cap on depreciation for business use vehicles to $10,000 in the first year, and each subsequent year receiving an enhancement. For example, in the second year, $16,000, in the third year, $9,600, and $5,700 in each subsequent year until the value of the vehicle is entirely depreciated. Many business deductions and credits were modified by this bill. First, the Domestic Production Activity Deduction, or DPAD as it's commonly known, was eliminated. DPAD generally has been helpful to businesses involved in manufacturing or production of their own goods domestically. Next, non-real property like-kind exchanges have also been eliminated. In simple terms, the trade-in of a business vehicle or piece of equipment can no longer be done on a gain-deferred basis. Taxpayers will recognize gain on trade-ins and exchanges of equipment. I suspect that the 100% bonus depreciation and the enhanced Section 179 will likely alleviate the additional gain taxpayers will recognize. Third, the research and development credit has been modified, requiring taxpayers to amortize the expenditures they earmark as research and development over 5 years. Next, the bill creates a credit for employers paying their employees for family or for medical leave. The bill also caps the deduction that business owners can take on interest expense to 30% of adjusted taxable income. Perhaps the most discussed element of business tax reform is the pass-through deduction. Historically, owners of partnerships, S corporations, and sole proprietorships, known as pass-through entities, pay tax on business income at their individual tax rates. The newly enacted bill allows for a 20% reduction in pass-through taxable income before being taxed at the owner's individual income tax rates. This 20% reduction is subject to a few limitations. First, businesses must be a qualifying trade or business. The bill excludes businesses that primarily perform services, such as health, law, consulting, financial services, and other businesses that rely on the reputation or skill of the owners. However, there is an exception. If the taxpayer has less than $315,000 of taxable income before the 20% deduction, the aforementioned limitation does not apply. Unfortunately, it is still a little unclear how trade or business is going to be determined or defined. The second limitation to the 20% reduction is related to the business's W-2 wages. The 20% deduction is generally limited to 50% of the W-2 wages of the business. This W-2 wage limitation would not apply, again, if the taxpayer's taxable income was less than $315,000 before the 20% reduction. Given that this can be a little difficult to understand, I wanted to walk you through an example. Suppose that we have a business that is a qualified trader business for purposes of this pass-through deduction. Let's suppose that this business, for simplicity's sake, has one owner, and that qualified business income for the year was $1 million. Let's also presume that this business has $220,000 of W-2 wages. In this instance, the pass-through deduction is limited to the lesser of two numbers, 20% of qualified business income or 1/2 of W-2 wages. In the example provided, the business owner would receive a pass-through deduction of $110,000 or 1/2 of W-2 wages paid in the current year. Merry Christmas and a Happy New Year from all of us at Cooper Norman. If you have any questions or concerns, please feel free to call us.